Welcome to Topic 8, Foreign Currency Transactions. In this topic, and Topic 9, we will be discussing different issues financial accountants face when dealing with foreign currencies, and AASB 121 will be our standard of focus. In this topic, we focus on foreign currency transactions, which are transactions by an entity denominated in a foreign currency. For example, an Australian company using the Australian dollar entering into a transaction with a US company using the US dollar. As businesses are becoming increasingly globalized, many companies are completing investments and transactions in different countries. And from an accounting perspective, this creates several challenges, as we must somehow convert foreign currency transactions into the currency in which the entity prepares their financial statements. Questions raised when dealing with transactions in foreign currencies include: how do we prepare the journal entries for initially recording foreign currency transactions? And how and when do we need to account for the gains or losses on the foreign currency when the exchange rate changes? Because we use the accruals basis of accounting, quite often the date a transaction is recorded is not the same as it is either paid or received. And with exchange rates between currencies changing over time, we need to adjust for the value change within our own accounts. A typical practice question would involve initially recording a transaction at the date it is entered, followed by a subsequent adjustment at the end of the reporting period date, and finishing with another adjustment at the date of settlement, where money is exchanged. With fluctuations in exchange rates, it can create a risk in an entity's financial position, performance, and cash flows. Making a commitment to buy or sell a good or service at a future date in a foreign currency means there is a risk that the exchange rate will move against the Australian dollar, and as a result, you end up paying more or receiving less than you originally intended. To protect against adverse movements in the exchange rates, an entity may enter into a forward exchange contract, which is an agreement between two parties to exchange a specified quantity of one currency for another at a specified exchange rate on a specific future date. Please note, for this topic, we will not be expecting you to complete a forward contract that involves hedging.